Today with Capital Turners, we're pleased to interview a passive real estate investor. And not just any investor, but a super self-educated Raymond Hooks III. There will be tons of great takeaways, whether you're a beginner investor to a mature real estate syndicator, or anywhere in between. I know you will really enjoy this interview today because we actually learned a few tricks from Raymond ourselves. If you listen till the end, you will learn why he became a passive investor. He'll talk how he likes to be approached from capital raising perspective, and also reveal some insights as to what are the red flags that would completely deter him from investing with syndication sponsor. Most importantly, how he came up with some creative ways for capital to invest. He's young and excited about financial freedom and investing while pursuing some early retirement goals for himself and his family. So on to you, Raymond.
Yeah, so my name is Raymond Hooks III. I am 31 years old. My profession is in chemical engineering, and I work for a major oil and gas company. So one thing that I like to do is I like to take financial matters more so into my own hand instead of just the traditional stocks, bonds, and mutual funds. So I have been taking a look at lots of alternative assets, and one of my goals is to not only have active income through my employer, but also to have passive income. So I came across real estate syndications because it turns out that that real estate is a hard asset, and it's been used by many people to multiply and expand their wealth.
That's fantastic. It's true. Real estate's a hard asset. I mean, after the couple of years we've had here, one of the things about our real estate portfolio is it's just not going to go to zero, and the stuff we have with 401ks and IRAs and all the generous stuff our employers do for us when you do work in W-2 are great. But if they're not going to meet your end goal, the 60-year-old you, maybe even the 50-year-old you, then, why do it? Why not look at some alternative investments? And one of the things I jotted down here, Raymond, is that, I'm not sure if you're exposed to it, but since you work in the oil and gas industry, I know the syndications are not uncommon in that business as well. Do you think that might be why you might be open to doing investments like this, alternative investments?
Yes, I have looked at other investments in oil and gas industry. Oil and gas drilling, for instance, has some really great tax benefits, and it can allow residual income to happen for many years. I've talked to someone who successfully invested in an oil well, interest, and they're still getting passive income 20 years after the project started. The only thing with that project is that it comes with more risk than what real estate does, because with oil and gas, either you're going to strike the oil or you're not. But with real estate, it's a hard asset, and you're going to get something. Because the biggest risk with the real estate syndications is the sponsor itself. Mm-hmm. So as long as you're investing with a reliable, with a trustworthy sponsor, you're pretty much gonna get something.
That's right. And you hear a lot of talk in syndication circles, and I'm sure at the conferences you've been to, know, like, and trust, right? You have to build that relationship. You have to know somebody, you have to like them, and you have to trust them. So
that's correct. How did you, I guess, like, you could have done so many different there's so many different investment options out there, or vehicles. What drew you to real estate syndications? As we're learning, a lot of folks within our circles, they never even heard of the term real estate syndication. They thought maybe something with pharmaceuticals, you name it, a lot of different possibilities, but never related to real estate. So what was your journey like that brought you to real estate syndications?
Oh, that's very interesting. So I have looked at quite a few investments over the last 5 years. I've looked at things from franchising. I've looked at, obviously, the stocks, the bonds, and mutual funds. I have looked at land flipping, buying single family homes. I've even looked at angel investing as well. But what really brought me to real estate syndications is that I personally am a busy professional and I don't want to have a large portfolio of single family homes because the property management is pretty intense there. And you only need one major unexpected expense and you can have negative cash flow on that single family home. So, what I would much rather do is focus on finding the syndicators that are good stewards of money and let them grow my capital for me while I passively watch the activities. And if they do a good job, I'll actually reinvest with them.
That's awesome. I do have a question. I don't see it. I do have a question, Raymond, about that. So of the syndications you're doing, what is your communications preference? What do you like to get from the GP team?
What I like to get from the GP team is I like to have full transparency on how the asset is performing. Every GP does things a little bit differently, but I would personally like to see monthly updates.
Monthly.
And if I can't see the financials on a monthly basis, I'd at least like to see it on a quarterly basis.
Mm-hmm.
Like when COVID came around, like one GP I invested with, he was actually providing biweekly updates and he was offering Zoom calls and kind of telling us about, how the assets were performing. So if something like another COVID situation comes up, definitely want to have, clear communication there.
Absolutely. That's good.
That's a good one. Now, what would draw you towards syndicator A versus syndicator B?
That's a great question. So what draws me to a syndicator is not their investment returns. In other words, over the last 5 years, pretty much anybody who has done syndication has delivered returns much higher than projections. So when I hear a syndicator say something like, I've delivered 50% IRR, or I've delivered a 2x multiple over this time period, I'm just sitting here thinking, well, that doesn't necessarily differentiate yourself from most because many people have done that. But what I like to see with a syndicator is I like to see someone who has an experienced team that's been together for a while, that has done full cycle deals, a syndicator that aligns their interests with investors. I like to see a syndicator that, like I mentioned earlier, offer clear communication. And one thing that I personally do as an investor is that I'm not going to invest with a syndicator if I don't know someone else that is invested that's also happy. In other words, I don't want to be, and exactly. I don't want to be the first person to try out this syndicator.
Yeah, that makes sense.
So let's get to the juiciest part of this conversation. I really was impressed with different investing options or funding syndications that you came up with over the phone. I think there's more that you have behind your belt. So I really would like to hear more for those that are looking to invest that have either W-2 income or they have some investment portfolios that could be leveraged to invest. So what are the options that you are aware of?
Yeah, if I just might clarify, so just for anybody that's new that might be tuning in. So normally for syndication, you need to have, a pretty decent amount of money, usually 50,000 or 100,000. Sometimes it's 25,000. Sometimes that's a good start for a beginner, but most of your qualified funds out there, like Raymond is talking about, are going to be, experienced syndicators, and they're going to want 50 or 100,000. So it sounds like Raymond had some creative ways to come up with that money. So let's hear it.
So there's probably about 10 things that a LP investor can do. So one thing that can be done is home equity line of credit. So real estate, single family homes have appreciated a lot over the last 3, 4, 5 years. So anyone who bought a house during that time frame, 2, 3, 4, 5 years ago, they have gained a lot of equity. So the home equity line of credits can be obtained, and depending on what state you're in, you can pretty much go up to 80 or 95% leverage on your property. But actually, one of my favorite ways of getting capital is by taking out a security-backed line of credit on my stock portfolio. What I love about this option here is that I can actually use up to 70% leverage on my stock portfolio, and I can get capital, and I can pretty much spend the money however I want to, besides using it to buy individual stock. So just an example, like if my individual stock portfolio is $100,000, I can take out a $50,000 security-backed line of credit, and I can use that to invest in a real estate syndication. Now, one of the downsides of security-backed line of credit is that you have to make sure that you don't get above 70% leverage. So if the stock market drops by 25 or 30%, then you're going to have to put in more capital. But usually the stock market long-term history goes up about 7 to 9% a year. So if you take this strategy, then you have to make sure that you put in more capital. And another thing I like about the security-backed line of credit is that the collateral for the loan is not you as an individual. You don't have to have a credit score, but the collateral is actually your stock portfolio. So in this case, you can be co-invested in a stock market, and you can be co-invested in into real estate. Another thing that I like to mention is, the monetary supply increased by more than 40% during COVID. So there were times where credit unions would send me emails and say, I'm going to give you this low interest loan for 3.9% interest as long as you refinance your car with me. So I've actually reached out to them, because I say 3.9% interest, that's less than inflation. And I know that I can get cash on cash returns higher than with real estate. And just kind of going back to security-backed line of credit, I forgot to mention this earlier, but one thing I did do is I got a loan on my stock portfolio, 3.7% interest.
Wow.
It's a 5-year interest only time period with a balloon payment due at the end. That is actually the cheapest form of debt that I'm aware of anyone can get.
Yeah, Raymond, I do have a question about the security-backed, loan. Where did you come by your stock? Are you getting stock as part of your job, or were you an investor previously, or a combination?
I would just get use a stock in my individual brokerage account.
Okay.
So with security-backed line of credit, you can't use it for a traditional IRA or HSA or Roth IRA. It has to be in an individual brokerage account. The security laws will not let you take the loan on one of those retirement accounts. So that just brings me to another point. Some people tend to use like a Roth IRA to put money in for a real estate syndication. But if you want to stretch your capital further, you can actually consider pulling money out of the Roth IRA without paying any tax penalties. You can consider pulling it out, putting it into an individual brokerage account, and then using that leverage. So in other words, if you invest in a real estate syndication and you're using $100,000 in a Roth IRA, you'll have to pay some UBIT and some UDFI. You'll have to get a CPA to file a tax return, and your tax rate can be up to 37%, depending on how much leverage is used, and depending on what type of depreciation may help out in the deal. But if you take that money out and you put it into an individual brokerage account, you can borrow against it, which would be the security-backed line of credit. You pay no tax on borrowing it out, and then you can use that money that you borrow, the $50,000, to go and invest in real estate. And one thing that I do want to mention is that the Roth IRA is an account that you can easily pull money from without having tax penalties. Like, you can pull your contributions out without the 10% penalty. If you've done a Roth conversion more than 5 years ago, you can pull that out without there being a 10% penalty. Pretty much, you can get access to almost anything after 5 years in your Roth IRA, as long as you're not pulling out the amount of interest or appreciation in the account.
That's a great point. That's a great point to make, Raymond. And what Raymond's talking about there is, if you have, say, a 401k, or you have a traditional IRA where maybe you left a job and rolled it into an IRA, but it's not a Roth. If you take that money out and you're below the age limit, you're going to have to pay a 10% penalty plus your tax rate. So you're going to get penalized pretty hard on that money. where he's speaking, if you convert and you have patience, again, getting rich, being wealthy, it's not a quick thing, it's a slow thing. So if you have the patience and you start to convert that money, you know, maybe you get a 5-year plan, you can follow Raymond's idea here and go ahead and put that stuff in a Roth, put it into your stock fund. Definitely read up on that, you know, talk to your accountant, talk to whoever you need to talk to, and you know, you might be able to make some investments that way. So it's a great way to do it.
And I should have mentioned this earlier, but I am not a CPA. I'm not an attorney. I'm not a financial advisor. I'm just speaking of my own opinion, and you should do your own due diligence along with validating with whoever you go to for financial guidance.
Absolutely, absolutely.
But one thing that I like doing is that I like taking my 401k from my previous employer, rolling it over into a traditional IRA, and then I like to do a Roth conversion where I take money from my traditional IRA over to my Roth IRA. And then after 5 years, I can pull that money out without paying a 10% penalty. So that is one way you can get money out of your 401k while avoiding a 10% penalty. But of course, the 5-year wait is a certain amount of time.
Mm-hmm, mm-hmm.
But if you start today in 5 years, or if we started 5 years ago, today we could have pulled it up. I wish we met you sooner.
Yeah, that's correct, because I do that conversion every year, and I'm able to, because some people may say, well, my employer is giving me a match on my 401k, and I'm not going to touch it till I'm 59 and a half. That's not true. And there's another strategy how you can take money out of your 401k without paying that 10% tax penalty. This one takes longer, but you could actually do a 72T plan where you pretty much agree to take out substantially equal distributions over a 5-year time period, and you don't have to pay any penalties on that. Of course, you have to pay tax on it and stuff like that, but you pretty much need a CPA or a financial advisor to set that up for you if you're going to take that route. But basically, the government doesn't really talk about this type of stuff, but there are quite a few ways that you can take money out of your 401k without paying that 10% penalty.
That's awesome. Before we get to our next set of questions, just still on funding. So you're funding your LP investments. Here's what I want to know, Raymond. What are you doing with your proceeds from your LP investments?
That's a good question.
Yeah, so when I get proceeds from my LP investments, so normally I'll get something like maybe a 5%, cash on cash return or something like that per year. And if you're investing something like $50,000, that's not going to be enough to reinvest in another LP deal. So what I personally like to do is instead of me just living off of it, I like to reinvest it, and I typically reinvest it in the stock market.
Absolutely.
So I just buy stocks, because now you look at the typical brokers like Fidelity, TD Ameritrade, UBS. You can do fractional trading, so you can buy fractional shares of stock.
That's awesome. That's a great way to keep recycling the money and get more out of it.
Yeah, and then you can use that money in stocks to take the loan against it. So you kind of like create in that circle of. Yeah.
And I personally haven't done this, but there are some investors that actually take out loans against their life insurances. They may have whole life insurance.
The infinity banking play.
Yep. They'll do the infinity banking play. I mean, I have term life insurance with living benefits. So at some point, after paying my premium for long enough, I may be able to do that as well. But that's something that's extremely helpful.
Absolutely.
And something else that I've seen people do is that there's actually a company out there that will pretty much give you a loan to help you fund your 401k. In other words, if you have a 5% 401k match, the company will give you the money to make that 5% contribution, and you don't have to necessarily pay the money back until you leave your employer. Now, I know that may be a small amount of money. Like if you make $100,000 a year and you got a 5% matched, and you're looking at $5,000 a year, but sometimes it's those little wins that help out, because if you're trying to invest in a real estate syndication and you only have like 40 or $45,000, you need to get to 50,000. Those are things that you can do to help get over the fence.
Yeah, that's a good point about that too. Is another play that I have seen some investors do is, a little bit of arbitrage where, they take that money out from their 401k at work on a loan where they're going to pay it back at a 3 or 4% rate, but they know that they're going to be getting a 12% return because, that's the deal they invested in. So they're still making a spread of, 7 or 8%, and they can still make their loan payments. But that's only for somebody that's, W-2, plans to stay at their job, because, one caveat with that is if you move to another job, that loan has to be paid back immediately. So something to think about.
That's correct. Because if you're gonna stay with your employer for 20 years, you can literally have them fund your 5% match. Mm-hmm. And then from there, you don't have to pay it back until you leave your employer. And what's beautiful about that is that the company only takes 20%, just a 20% fee. So in other words, if I work in my employer for 20 years, and let's just say that they give me, I don't know, $100,000 or so in 401k match, mm-hmm. I would only have to pay them 20% of the amount of match money. So it's pretty much like you're, over long time periods, you're getting free money, and you're not having to pay anything until you leave your employer.
Yeah, if you have a resource about that too, you can send it to us after. We can put it in the show notes for sure. So
absolutely,
that's an interesting idea for sure.
Absolutely. And then there's other strategies as well. Like if you have a business, and your business is cash flowing, and you need to get access to capital so you can invest in real estate syndication. There's actually some business credit cards that offer interest-free financing for 12, 18, and 24 months. So you can even temporarily relocate some expenses to that credit card. Of course, there's going to be a minimum payment of 1%, but if you have 0% interest for that amount of time frame, you can literally accumulate interest there without using your personal credit. It will not impact your personal credit score, and then use your business cash flow to go buy some of the interest in the real estate syndication.
Well, talk about creative, for sure.
Yes, that's what I'm saying. We need to talk to the gentleman. He's so young, he's so ambitious, and how many other 31-year-olds have we met that are already like thinking about what they want to do in 10 years?
It's just it's just wonderful to see your focus on truly passive investments. Like you have gone ahead and qualified what Raymond's going to do for him and his family, and you know that you don't want to have to spend too much time on it. So that's awesome, Raymond. I commend you for that.
Thank you. And something else I can mention is that some people might actually have an active business. And when I say active business, you pretty much just have to have the intent of making income. I mean, you can even make a few $1,000s a year and profits or something like that. But some people actually get a solo 401k set up, and the tax law allows you to borrow up to $50,000 from the solo 401k. Of course, you're going to have to pay it back over time. You're going to have to pay some interest, but pretty much what you're doing is that the solo 401k, you're borrowing pre-tax money, you're paying the money back to yourself, and then you're also paying interest back to yourself. But you can pretty much borrow money from your solo 401k and use that to invest in real estate as well. So that's another way how you can get instant access to funds.
Awesome.
Yeah. So Raymond is a great example of the person who, if there is a will, there is a way. If you want to start investing into real estate, if this conversation doesn't fire up, I don't know what else will. I mean, all right. Another question I wanted to check check in with you on is what would you say are, from your experience, what are the red flags when it comes to real estate syndication or the sponsors that offering their services? And there's so many. Once you type in, real estate syndication, you start to get all those sponsored ads, and they somehow find you on LinkedIn, and you get all those requests wanting to befriend you and sending you all those messages, invitations, trying to set up calls. So how do you, I guess, filter through that and the red flags that you've experienced?
There could be a lot of red flags, but I'll kind of talk about some of the obvious ones. One of the obvious ones is if the syndicator has a financial criminal history, or if the syndicator is involved in active litigation, I would not invest with them, because that adds a lot of risk for me as a passive investor.
Absolutely.
If I
How would you
find out,
find that though? I'm sorry for interrupting. How would you know if they have a criminal history other than just searching Google?
you'd be surprised what you can find from Google, but if you want to get a good thorough search done, you have to hire an attorney to do that for you. There are some online court docket tools that you can use and pay for. I mean, there's one that's like $100 a month that you can subscribe to do your own searches. But basically, yeah, if you want to do a thorough search, I mean, if you're investing like $100,000 or $200,000, I mean, the amount of money you pay the attorney will definitely be worth it, because it's definitely worth the amount of money. You might pay an attorney, $1,000 to do the search or something. But the point is that is a huge red flag if I find some litigation. And I've actually seen litigation going on with one person that I was considering to invest with, and I said, no way, I'm not doing it. That was the end of conversation.
There you go. Next.
Yep. Yeah, so that's one red flag. Another red flag is if I can't find anyone else that has invested with them. In other words, if they can't provide a reference, or I can't find someone that is invested and that is happy, then I don't necessarily want to be a guinea pig. I don't want to just do things by trial and error. And something else that a lot of people don't even think about checking, which could be a red flag, is that the real estate syndication industry is regulated by the SEC. If I see that the syndicator is not listing the offering on the SEC Edgar database, then I'm going to start asking questions. Sometimes it may be, like a silly mistake or something, but
it could be a delay if it's a fresh
or a
deal.
Yeah, or a delay or something. But if I don't see their name listed, I'm definitely gonna have some questions, because I need to make sure that they're following, what the 506B or the 506C rule states.
Yeah, that's very key.
Yep. Another thing that could be a red flag is if they're pressuring you to invest with them. Like if they're saying, okay, this is a limited time offer, you're never going to see anything like this again, and you have to hurry up. I mean, if they're putting pressure on you to do it, then that's gonna kind of pull me away a little bit, because from my standpoint, I'm okay passing up on an offering every now and then. I'd rather take time to get to know the syndicator. If I have to watch them for 3 months or 6 months or whatever, I'm willing to do that. But I'm not going to let anyone, especially if they're calling me, 2-3 times a week and saying you have a limited amount of time. Usually when a syndicator has a lot of interested investors, they're not having time to call you 2 and 3 times a week.
No, and some of the best operators out there, when they do have a deal, they're going to hit you up maybe a few times in a week. But once you say, I'm out this time around, they'll be like, okay, we'll catch you on the next time, no big deal. Because they know it's a cycle. I mean, it's a big investment, and maybe you just did it. Maybe you're, waiting for some more returns or some other personal financial matter. So
what are your thoughts on, I guess, social media and sponsors advertising their services on social media? Like, where do you draw the line for yourself as an LP? Like, what's an attractive social media practice, and what's a distraction? And like, no, I don't want to invest in that.
Good question.
Well, I'm actually glad that you brought that up. So most of the type of offerings I have looked at and participated in has been the 506B. But obviously with a 506B, they're not able to publicly advertise the offering. So if I see that they are publicly advertising the offering, and I know that it's a 506B, then once again, that's another red flag. But I personally like seeing syndicators not promoting the investment opportunity, but basically promoting themselves as an individual. I like seeing that on social media, because give you an example, like if I see a syndicator doing frequent posts on Facebook and frequent posts on LinkedIn, I pay attention to who likes their post and who comments
Mm.
on it, because more than likely those are going to be passive investors that are engaged, and I can talk to those passive investors one-on-one, not in a public setting, and say,
Yeah.
hey, how do you like investing with this syndicator here? Are you happy? Is the communication clear? And if I hear good feedback from, multiple individuals, then I can contact the syndicator and say, hey, let's go ahead and establish our pre-existing relationship, and then I can consider an investment opportunity with them.
Mhm. And do you like, so I noticed some of the syndicators, so I like to do videos. I'm more of a visual, like this is how I transport my energy out. And I know a lot of folks, they like to type in like, paragraphs and stuff. So which type is your type of media, I guess?
For me, I would say all of the above, to be honest with you.
Mhm.
Like, I love just getting on LinkedIn and just seeing a mixture of, pictures and videos and, written paragraphs. But typically the videos and pictures, get a lot more views and a lot more attention than just the writing up of just a plain paragraph. So, but yeah, all of it is really great. So one thing I can say is that from an LP investor, I know that deals kind of come and go, and a GP is not going to have a deal all the time. But I like to hear from the GPs at least a couple times a month. I like them to keep me engaged. And if they don't really have an investment opportunity or something like that coming up, maybe they can just post stuff on YouTube, and it could just be a random topic like here's how fees work in syndications, or this
Educational,
is,
it's
Yeah.
yeah,
educational.
just educational content. And
Mhm.
some syndicators don't do that there. The only time you'll hear from them is when they have an investment
Good deal.
opportunity. It's like, oh, I haven't talked to you for 6 months. Why am I going to consider investing with you?
Interesting point.
Yeah.
That's great to hear, because as as we are syndicators, and there's so many other syndicators that they don't hear the other side of the story, right? Like talking with a source who actually might be a potential investor, and hearing how they would like to be approached.
Absolutely.
So for me, this is great feedback.
That's a value bomb.
Yeah,
Sure.
absolutely. Maybe we'll cut it up. Do you like email marketing? Do you like to stay in touch with your syndicator through email marketing?
Email marketing helps, but as long as it's not too frequent, because there's actually some syndicators that send me like 3 or 4 emails a week, and I'm like, it's just overwhelming.
Yeah.
It's just too much information. Some LPs like the email marketing, but personally, my favorite is just the social media presence,
Yeah.
You go
because
when
I
you
can always, yeah, I mean, I can always set up alerts, and I can always, go see what's going on there.
but on your own terms though, right?
On my own terms. And it's like, if I just get too many email marketing 3 or 4 week, I'm just going to unsubscribe and lose contact with them. And that can be a huge turnoff to me, especially when it's not really meaningful content.
Raymond, let me ask you this. So when you are analyzing a deal and attending the webinar, I think I know when it's going to be, but when are you absolutely paying the most attention? What is the meat and potatoes when you are seeing a new deal and they're going over in a webinar?
What I pay attention to the most is I want to know more about the background of the sponsor. So when it comes to underwriting a deal, a sponsor can easily tweak the numbers to make the IRR or the equity multiple turn good if they're doing something like adjusting the occupancy or adjusting the exit cap rate,
Value add.
or reducing the amount of expenses. I mean, I actually have I have an underwriting tool, and I've actually done a lot of studying on it, and you only have to change like 2 or 3 variables to make the LP returns go from like a 5% IRR up to like a 30 or 40% IRR. So for me, it's like I'm more so focused on what's the background of the syndicator, what is their experience, what have they done in the past for investors. I've seen syndicators, show me beautiful pictures like, this is new carpet that's been put in, this is new, oven and stove. That type of stuff doesn't really get my attention, because yeah, the pictures and everything is nice, but I'm more so focused on what is the capability, what is the qualification of the syndicator.
The team itself, yeah, which is usually when you do see these things, and as a new investors, folks will hopefully tune into some because it's free. You can tune in, but you may get some emails every week. But what Raymond's talking about is the most important part for him is the beginning, and usually it's the very shortest part. So talking about the team, their history, their bios, what they've done. Yep.
And the reason why that's the case is because a good syndicator can always bring a good deal.
Mm-hmm.
And a bad syndicator can bring a good deal, but they can also make that good deal turn bad.
Yeah.
So I like to spend more time understanding who the syndicator is. And once I find someone that's a good steward of my money, then I'll ask some questions in particular about the deal. Like I personally don't believe that a good syndicator will try to go buy a multifamily unit where the population is declining and unemployment is increasing. And I personally have not seen a good syndicator do that. But usually, like I said, the biggest risk is who you invest your money with.
Absolutely.
Yeah, that's a great point. And I know we're meeting in next week to look at some underwriting that we've done so we can show you how we do it. So we're looking forward to that feedback based on what you've seen from other people, how they do it. So, all right. And then I know we've picked your brain a lot today, so let's maybe wrap it up with the last question. So folks that are watching and, are getting really excited with all the funding opportunities that we went over and opportunities with becoming a passive investor in the future, and something that hopefully that's what they've always wanted to do. And in order for them to get started, based on what you know now, that you already have a certain investing experience and the tremendous research that you've done in that industry, what's one thing that you would, what kind of advice would you give someone that's looking to get their feet wet with real estate syndications?
One thing I would suggest is that the LP investors go attend real estate conferences, the ones that are in person, the ones that let you meet people. And I would suggest that when you go to the conference, don't make your primary focus be on trying to meet the syndicators, but try to make your primary focus be to meet the LP investors, because the LP investors can share their experiences with you. They can tell you which GPs are doing a very good job. And then you can reach out to the GP either during the conference or after the conference, and you can establish a relationship with them. Another thing that I would suggest is that for an LP, don't make an investment in this type of business until you really understand what's going on, because your money is illiquid once you make the investment. You don't have to be an expert. You don't have to know every little detail like a GP, but you do need to have some background and understand what's going on here. Because if you're just making an investment just because you like someone's YouTube video and you don't really understand what they're doing, then you're really just speculating. So you do have to get to know the syndicator that you're investing with.
Yeah, I really like the idea of going into conferences, because we go into conferences for networking because we are in the industry already. But I wonder how many folks actually do go to conferences because they want to start investing.
I've run into some, but it's not too common. I almost think if you go there, you should have a T-shirt that says "I'm an LP investor." Because yeah, I know that was supposed to be the last question, Raymond, but you look like a fun person, so I'm just having a little fun with my notepad here, and we're talking a lot about funding, but if we broke it into two things like fun and ding, like a bell, what rings your bell for fun? What do you do for fun?
Let's see. For fun, I spend time with my family. So awesome. I have a wife and I have 2 young kids. So I have a 3-year-old and 11-month-old. And to be quite honest with you, my wife and I both have W-2 jobs. We both work full time, and the kids take up a lot of our time. At this point, I'm just focused on the development and the growth of my kids, and
they keep you young,
and try to get some rest when I can.
Absolutely. Well, thanks for sharing that with us, and thanks for some of your precious time today. We really appreciate it.
Thank you. I appreciate it as well.
Wow, this was fantastic. So much wisdom from Raymond. And did you see that passion for investing I told you about? Yes, he is all that and more. Self-educated limited partner. So many options on how to invest, and clearly he is pursuing an opportunity for passive investing. So his time can be free to be with his family. Does his story resonate with you? Certainly does with us. Time freedom is our biggest why behind passive investing as well. And real estate is a team sport. So here's how you can get on our list to stay on top of the current offerings. And happy investing!